Let me ask you something that might change how you think about building wealth in retirement. What if I told you that one of the oldest, most boring industries in the world, an industry that most investors completely ignore, could generate more passive income than almost any dividend stock on the market? I am talking about shipping, the business of moving goods across oceans. And before you click away thinking this sounds too obscure or too risky, let me tell you why I believe two specific shipping companies deserve a place in any serious income investor's portfolio. I have been investing for over 70 years. I have seen industries rise and fall. I have watched technology transform how we live and work. But through all of that change, one thing has remained constant. Goods need to move from where they are made to where they are consumed. And most of that movement happens on ships. 90% of world trade travels by sea. 90%. That is not going to change in our lifetimes, no matter what happens with technology or politics or anything else. Now shipping has a terrible reputation among investors, and I understand why. The industry is notoriously cyclical. Fortunes have been made and lost. Companies have gone bankrupt. The sector is filled with value traps that look cheap but destroy wealth. But here is what most investors miss. Within this challenging industry, there are a handful of companies that have figured out how to generate consistent, reliable income for shareholders, regardless of what the broader shipping market does. These companies are rare, they are special, and today I am going to share the only two I would trust with my capital for passive income. Let me take you back to 2015. I was sitting in my office in Omaha, reading through annual reports as I do every day, when something caught my attention. The shipping industry was in the middle of one of its worst downturns in decades. Freight rates had collapsed. Companies were going bankrupt left and right. The Baltic Dry Index, which measures shipping rates for bulk commodities, had fallen over 90% from its peak. Investors were running for the exits. Nobody wanted anything to do with shipping stocks. But as I studied the industry more closely, I noticed something interesting. While most shipping companies were bleeding money, a few were still paying dividends. Not just paying them, but increasing them. These companies had structured their businesses differently. They had long-term contracts that locked in revenue regardless of spot market rates. They had conservative balance sheets with manageable debt. They had management teams that prioritized returning cash to shareholders rather than empire building. I started digging deeper. I wanted to understand what made these companies different. Why could they thrive when their competitors were failing? The answer came down to business model design. These were not traditional shipping companies that gambled on freight rates. These were infrastructure businesses disguised as shipping companies. They owned essential assets, leased them out on long-term contracts, and collected predictable cash flows that they distributed to shareholders. That insight changed how I think about the shipping industry. Most shipping stocks are indeed terrible investments, but the ones that operate as floating infrastructure, the ones with long-term contracts and disciplined capital allocation, those can be exceptional income generators. And that brings me to the framework I use when evaluating any shipping company for passive income potential. There are 5 criteria I look for, and a shipping company must pass all 5 before I would consider investing. Let me walk you through each one, because understanding this framework will help you evaluate not just the 2 stocks I am going to recommend, but any income investment you consider in the future. The first criterion is contract structure. I want to see long-term contracts that lock in revenue for years or even decades. Spot market exposure is the enemy of passive income when a company's revenue depends on daily or weekly freight rates. Your dividend depends on factors completely outside anyone's control, but when a company has contracts that guarantee payments for 5, 10, or even 20 years, you can project cash flows with confidence. The best shipping companies have average contract durations of 10 years or more. And that means even if the shipping market collapses tomorrow, your dividend checks keep coming. The second criterion is counterparty quality. A long-term contract is only as good as the company on the other side of it. I want to see contracts with major corporations, preferably investment, grade-rated companies that have the financial strength to honor their commitments through any economic environment. If a shipping company's contracts are with small, financially weak customers, those contracts might not survive a recession, but if the customers are companies like Shell, BP, Chevron, or other global giants, you can sleep well at night knowing those payments will arrive. The third criterion is balance sheet strength. This is where most shipping companies fail. The industry has a terrible habit of taking on massive debt to finance new ship construction, then struggling to service that debt when rates decline. I want to see debt levels that are manageable even in the worst case scenario. Specifically, I look for debt to equity ratios below 1, and I want to see that the company can cover its interest payments multiple times over with operating cash flow. A conservative balance sheet is not just about survival. It is about having the flexibility to maintain dividends when competitors are cutting theirs. The fourth criterion is dividend history and policy. I want to see a track record of consistent, preferably growing dividend payments through multiple market cycles. Anyone can pay a high dividend for a year or two when times are good. The test is whether they keep paying when times are tough. I also pay attention to how the company thinks about dividends. Do they view the dividend as a sacred commitment to shareholders, or do they treat it as a residual after other priorities are funded? The best companies have explicit policies about returning a certain percentage of cash flow to shareholders, and they stick to those policies through thick and thin. The fifth criterion is fleet quality and maintenance. Ships depreciate. They require constant maintenance. Eventually, they need to be replaced. I want to see companies that maintain their fleets properly and have clear plans for fleet renewal. A company that skimps on maintenance or lets its fleet age without replacement is borrowing from the future to pay dividends today. That is not sustainable. The best companies have modern, well-maintained fleets and disciplined capital expenditure programs that ensure the business remains competitive for decades. Those are my 5 criteria: contract structure, counterparty quality, balance sheet strength, dividend history, and fleet quality. Most shipping companies fail on at least 2 or 3 of these criteria, but the 2 companies I'm about to share with you pass all 5 with flying colors. These are the only shipping stocks I would trust for passive income. The first shipping stock I would recommend for passive income is a company that operates in the liquefied natural gas sector. Now, before your eyes glaze over at the technical terminology, let me explain why this particular corner of the shipping industry is so attractive for income investors. Liquefied natural gas, or LNG, is natural gas that has been cooled to negative 260 degrees Fahrenheit, which turns it into a liquid that can be transported by ship. This is how natural gas moves from places that have lots of it, like Qatar and Australia and the United States, to places that need it, like Japan and South Korea and Europe. The LNG trade has been growing rapidly for decades, and it is expected to continue growing as countries transition away from coal toward cleaner energy sources. But here's what makes LNG shipping special from an investment perspective. LNG carriers are incredibly expensive to build, often over $200 million each. They require specialized technology and expertise to operate, and there are only a few shipyards in the world capable of building them. This creates significant barriers to entry that limit competition. More importantly, the companies that ship LNG typically do so under very long-term contracts. An oil company or utility that needs LNG delivered is not going to sign a 1-year contract. They need reliable supply for decades to justify the massive investments they make in import terminals and power plants. So they sign 10, 15, even 20-year contracts with shipping companies. These contracts typically include inflation adjustments and guarantee minimum payments even if the ship sits idle. The first company I would trust for passive income in this space has built its entire business model around these long-term contracts. They own a fleet of modern LNG carriers, and virtually every ship is locked into a long-term charter with a major energy company. The average remaining contract duration is over 10 years. That means the revenue you see today is largely guaranteed for the next decade. The counterparties on these contracts read like a who is who of the global energy industry. Shell, BP, Total, Cheniere Energy, and other major players. These are not fly-by-night operators who might disappear in a recession. These are companies that have been around for a century and will be around for another century. When they commit to a 20-year contract, they honor it. The balance sheet is conservative by shipping industry standards. The company has maintained debt levels that allow it to comfortably service its obligations, even if something unexpected happens. They generate far more cash flow than they need to cover interest payments. This financial cushion means the dividend is secure even in challenging times. And speaking of the dividend, this company has an exceptional track record. They have paid quarterly distributions consistently for over a decade. Through the oil price collapse of 2014 and 2015, through the pandemic in 2020, through the interest rate increases of 2022 and 2023, the checks kept coming. That consistency is rare in the shipping industry, and it reflects the quality of the underlying business model. The current yield on this company is typically in the 8 to 10% range, which is exceptional for a company with this level of contract coverage and counterparty quality. You would be hard-pressed to find another investment that offers this combination of yield and safety. Most high-yield investments are high-yield because they are risky. This company is high-yield because the market does not understand how stable the cash flows really are. The fleet is modern and well-maintained. LNG carriers have useful lives of 30 to 40 years when properly maintained. And this company invests appropriately in keeping their ships in top condition. They also have a disciplined approach to fleet renewal, ordering new ships when attractive opportunities arise, but never overextending financially to chase growth. One thing I particularly appreciate about this company is how management thinks about capital allocation. They have explicitly stated that their primary goal is to return cash to shareholders. They do not chase acquisitions for the sake of getting bigger. They do not hoard cash on the balance sheet unnecessarily. They understand that their job is to operate ships safely and efficiently and send the profits to owners. That alignment of interest between management and shareholders is essential for any income investment. Now, let me tell you about the second shipping stock I would trust for passive income. This company operates in a different segment of the shipping industry, but the business model philosophy is remarkably similar. They have taken a volatile industry and engineered stability through long-term contracts with high-quality counterparties. This second company focuses on marine transportation of crude oil and petroleum products. Now, I know what you might be thinking. Oil tankers, is that not incredibly cyclical? And you would be right that the traditional tanker business is among the most volatile. All of shipping spot rates can swing from $10,000 per Dalton Y to over $200,000 per Dalton Y, depending on global supply and demand for shipping capacity. But this company does not play that game. They have deliberately structured their business to avoid spot market exposure almost entirely. Instead of gambling on daily rates, they charter their vessels on long-term contracts, typically 5 to 15 years, to major oil companies and refineries. These contracts guarantee fixed daily rates regardless of what the spot market does. Think about what this means for you as an income investor. When you buy shares in a traditional tanker company, your dividend depends on what happens to freight rates over the next quarter. A war in the Middle East might send rates soaring and your dividend doubles. A global recession might crash rates and your dividend gets cut to zero. That is not income investing, that is speculation. But when you buy shares in this company, your dividend depends on contracts that were signed years ago and will remain in force for years to come. The revenue for next year is already locked in. The revenue for the year after that is largely locked in. You can project cash flows with remarkable accuracy because the business has been engineered for predictability. The counterparties here are equally impressive: major international oil companies, national oil companies from the Middle East and Asia, large refineries that need reliable transportation for their crude supplies. These entities have been moving oil for decades. They understand the importance of reliable shipping partners, and they are willing to pay a premium for that reliability, which is reflected in the rates this company earns on its long-term contracts. The balance sheet is strong. Management has been conservative about taking on debt, especially compared to peers in the tanker industry. They have access to credit facilities that provide flexibility, but they have not loaded up on leverage to juice returns. That conservatism might mean slightly lower returns in boom times, but it means much more stable dividends across all market conditions. The dividend track record speaks for itself. This company has paid distributions consistently through multiple shipping cycles. They did not cut during the oil price collapse of 2014 through 2016, when many tanker companies eliminated their dividends entirely. They maintained payments through the pandemic when global oil demand temporarily cratered. That consistency comes from the contract structure, not from financial engineering or luck. The yield on this company typically runs in the 7 to 9% range, which is attractive but not so high as to signal distress. When you see a shipping company yielding 15 or 20%, that is usually a sign that the market expects a dividend cut. The more moderate yield here reflects the market's recognition that these dividends are sustainable. The fleet is well suited for the long-term contract market. These are modern, efficient vessels that oil companies want to charter for extended periods. Older, less efficient ships might compete for spot market cargoes, but they are not attractive for long-term deals. By maintaining a high-quality fleet, this company ensures it remains the preferred partner for customers seeking reliability. Management communication with shareholders is excellent. They provide detailed breakdowns of contract coverage, average remaining contract duration, and counterparty exposure. There are no hidden surprises. You can see exactly what you are buying and make an informed decision about whether the risk-reward makes sense for your portfolio. Now let me bring these two companies together and explain why I believe they deserve consideration for any income-focused portfolio. What these companies share is more important than how they differ. Both have taken inherently cyclical businesses and transformed them into predictable income generators through intelligent business design. The key insight is that shipping infrastructure can be separated from shipping speculation. Most shipping companies are in the speculation business. They buy ships, put them in the spot market, and hope rates stay high. That is a terrible business for income investors. But these two companies are in the infrastructure business. They own essential assets and lease them to creditworthy customers on long-term contracts. The ships are just the medium. The real product is reliability and predictability. This distinction matters because it explains why these companies can maintain high dividend yields without excessive risk. Traditional high-yield investments fall into two categories. Either they are genuinely risky, and the high yield compensates for the possibility of capital loss, or they are misunderstood by the market and offer a genuine opportunity. These shipping companies fall into the second category. The market sees shipping and assumes volatility, but these specific companies have engineered away most of that volatility through their contract structures. I also appreciate the diversification these companies provide. Most income portfolios are heavily concentrated in a few sectors. Utilities, real estate investment trusts, telecommunications, consumer staples. These are all fine sectors, but they tend to move together. When interest rates rise, they all suffer. When the economy slows, they all face pressure. Shipping infrastructure is different. The demand drivers are global trade flows, energy security, and industrial production. These factors do not correlate perfectly with domestic interest rates or consumer spending. Adding shipping income to a portfolio that already includes traditional dividend stocks can reduce overall volatility while maintaining or even increasing total yield. That is exactly what diversification is supposed to accomplish. You are not just spreading money around randomly. You are combining assets with different risk factors so that when one part of the portfolio struggles, another part holds up. Let me address some concerns you might have about investing in shipping companies for income. These are legitimate questions that deserve honest answers. The first concern is regulatory and environmental risk. The shipping industry is facing increasing pressure to reduce emissions. New regulations are coming that will require ships to use cleaner fuels and meet stricter efficiency standards. Will this hurt the companies I have recommended? The honest answer is that it might create some transition costs, but both companies are well positioned to adapt. Their modern fleets are more fuel efficient than older vessels, which provides a competitive advantage as environmental regulations tighten. The long-term contracts they operate under typically include provisions for passing through additional costs related to regulatory compliance. And fundamentally, if the world wants to reduce shipping emissions, it needs modern, efficient ships. Like the ones these companies operate, older, dirtier vessels will be retired, creating more demand for the high-quality capacity these companies provide. The second concern is geopolitical risk. Ships traverse international waters, they call it ports, in dozens of countries. Political conflicts can disrupt trade routes. We have seen this recently with tensions in the Red Sea and the Panama Canal drought affecting global shipping patterns. How do these companies handle geopolitical uncertainty? The contract structures provide significant protection here. When a ship is on a long-term charter, the customer bears most of the operational risk. If a particular route becomes dangerous, the charterer decides how to respond. They might reroute the ship, accept delays, or find alternative solutions. The shipping company continues to receive its contracted payments regardless. The geopolitical risk is not eliminated, but it is largely transferred to the charterer, who is better positioned to manage it. The third concern is interest rate sensitivity. Shipping companies typically carry significant debt, and higher interest rates mean higher borrowing costs. Is this a problem for the companies I have recommended? Both companies have been conservative about debt levels, which limits their exposure to interest rate increases. They also benefit from having locked-in borrowing costs on much of their existing debt before rates rose. Going forward, higher rates will affect the cost of any new financing. But both companies generate enough cash flow to fund most of their needs internally, and importantly, in an inflationary environment that leads to higher interest rates, the inflation adjustment provisions in their contracts help protect revenue. The fourth concern is obsolescence risk. Ships are physical assets that depreciate. New technology could make existing vessels less valuable. What happens when these ships reach the end of their useful lives? This is a legitimate long-term consideration that both companies address through their capital allocation strategies. They do not distribute every dollar of cash flow to shareholders. They retain enough to fund ongoing maintenance and eventual fleet renewal. The useful life of well-maintained vessels is 30 to 40 years, which is longer than most investors' time horizons. And the specialized nature of LNG carriers and certain tanker classes means that new capacity cannot be added quickly. Even as older ships retire, supply constraints should support asset values. Now let me talk about how to think about position sizing and portfolio fit for these investments. I never recommend that anyone put a large percentage of their portfolio into any single stock, no matter how confident I am in the thesis. These shipping stocks should be considered as part of a diversified income portfolio, not as standalone investments. A reasonable allocation might be 3 to 5% of a total portfolio to each of these companies. For a combined shipping exposure of 6 to 10%, that is enough to benefit meaningfully from the attractive yields and diversification benefits, but not so much that problems in the shipping industry would devastate your overall portfolio. I would also suggest building positions gradually rather than investing everything at once. The stocks can be volatile in the short term, even though the underlying businesses are stable. Averaging in over several months lets you benefit from any price dips while reducing the risk of buying at a temporary peak. Consider the tax implications of your specific situation. The dividends from these companies are typically qualified dividends that receive favorable tax treatment for us investors, but the details can vary. If you are investing through a tax-advantaged account like an IRA, the tax treatment is less relevant, but in a taxable account, you should understand the tax consequences before investing. Finally, maintain realistic expectations about total returns. These are income investments, not growth investments. You should expect the bulk of your returns to come from dividends rather than capital appreciation. The stock prices will fluctuate sometimes significantly, but over the long term, the value comes from the reliable cash payments rather than from share price increases. As I think about what makes these companies worth owning, I keep coming back to a simple principle that has guided my investing for decades. The best investments are the ones where you understand exactly how you are going to make money. With these shipping companies, the path to returns is clear. They own ships. They lease those ships on long-term contracts to creditworthy customers. They collect the lease payments and distribute most of the cash to shareholders. There is no mystery, no speculation about future growth, no dependence on things going right in unpredictable ways. Just assets, contracts, cash flows, and dividends. That clarity is what allows me to sleep well at night when I own these stocks. I do not need to predict oil prices or freight rates or global trade volumes. I do not need the management team to make brilliant strategic decisions. I just need the contracts to continue being honored and the ships to keep operating, given the quality of the counterparties and the track record of the operations. That is a reasonable expectation for anyone approaching retirement or already in retirement. Investments like these can form the backbone of an income strategy. The yields are high enough to generate meaningful cash flow from a reasonably sized portfolio. The stability is sufficient to avoid the gut-wrenching volatility that makes retirees panic and sell at the worst times. And the businesses are simple enough to understand that you do not need a finance degree to monitor them. That simplicity matters more than most people realize. When you own complex investments that you do not fully understand, you are always at risk of being surprised. Something happens that you did not anticipate, and you do not know whether to hold, sell, or buy more. With these shipping companies, there are no complex derivatives, no financial engineering, no opaque structures. Ships, contracts, cash flows, dividends. If you can understand that, you can understand these investments. The shipping industry will continue to evolve. New routes will open. Old ones will fade in importance. Technology will improve efficiency. Regulations will change how vessels operate. But through all of that evolution, goods will need to move across oceans. Energy will need to flow from producers to consumers. And the companies that provide this essential infrastructure, the ones that do it reliably under long-term contracts with the strongest customers in the world, will continue generating cash that flows to shareholders. Let me share something about how I think about income investing that applies to these shipping stocks, but also to any dividend investment you might consider. The biggest mistake income investors make is chasing yield without understanding what supports that yield. When you see a stock yielding 12 or 15%, your first instinct should not be excitement. It should be skepticism. You should ask why the yield is so high and whether it is sustainable. High yields typically come from one of three sources. First, the company might be genuinely risky, and the market is pricing in a high probability of dividend cuts or capital loss. Second, the company might be in a declining industry where current dividends are being paid from a shrinking asset base. Third, and most rarely, the company might be misunderstood by the market and genuinely offer an attractive risk-adjusted return. The two shipping companies I have described fall into that third category. Their yields are high not because they are risky, but because the market applies a blanket discount to anything labeled shipping. Sophisticated investors understand the difference between these companies and traditional shipping operators, but many market participants just see the sector classification and assume volatility. That assumption creates opportunity for those willing to do the work of understanding the actual business model. I want to elaborate on why the long-term contract structure is so important, because this is really the key to everything. When you think about most businesses, their revenue next year is uncertain. A retailer does not know how much people will spend. A manufacturer does not know what demand will be. Even utilities, which are considered stable, face some uncertainty about usage patterns and regulatory outcomes. But when a shipping company has a vessel on a 15-year charter with Shell or BP, the revenue for that ship is not uncertain. It is contracted, barring an actual bankruptcy of the counterparty, which is almost inconceivable for these investment-grade energy giants. The payments will arrive on schedule. This is as close to certain revenue as you will find in any equity investment. Now multiply that by a fleet of 20 or 30 or 40 vessels, each on its own long-term contract, and you have a diversified portfolio of contracted cash flows. Even if something goes wrong with one contract or one vessel, the impact on total company revenue is limited. The diversification is built into the business model. This contract visibility also affects how these companies can manage their own financing. When you can show a lender that your revenue is locked in for the next 10 years, you can borrow at more attractive rates than a company with uncertain cash flows. That lower cost of capital translates into higher returns for equity holders. It is a virtuous cycle where stability creates more stability. Let me also discuss reinvestment risk, which is something income investors often overlook. When you receive a dividend, you need to do something with that cash. If you are reinvesting, you are buying more shares at whatever price happens to prevail at the time. If interest rates have risen or market conditions have changed, your reinvested dividends might not generate the same returns as your original investment. With these shipping companies, the dividends are substantial enough that reinvestment decisions matter. If you are reinvesting the 7 or 8 or 9% yields these companies provide, you are accumulating meaningful additional shares over time. In a decade, those reinvested dividends could represent 20 or 30% of your total position. That compounding effect is how income investing builds real wealth over time. Some investors prefer to take the dividends in cash rather than reinvesting. That is a perfectly valid approach, especially in retirement when you need income to cover living expenses. The beauty of these shipping stocks is that they work for both strategies. The yields are high enough to provide meaningful current income if you need it, and they are consistent enough to support a reliable reinvestment program if you do not. I should mention the role that shipping plays in the global economy, because understanding this helps you appreciate why these businesses will remain relevant. We live in an interconnected world where products are manufactured where production is cheapest and consumed where demand is highest. A smartphone might contain components from a dozen countries before being assembled in China and sold in the United States. Every step of that process involves shipping. The pandemic revealed how dependent we have become on global supply chains. When shipping was disrupted, store shelves went empty, car factories shut down for lack of parts, construction projects stalled for lack of materials. That disruption was painful, but it also demonstrated the essential nature of maritime transportation. Ships are not an optional luxury. They are the arteries through which the global economy flows. Energy shipping is even more critical than general cargo shipping. Countries do not have the option of doing without energy. They need oil to fuel their vehicles and generate electricity. They need natural gas to heat homes and power industry. And since energy resources are not evenly distributed around the world, massive amounts of oil and gas must move by ship every single day. Japan imports virtually all of its oil and gas by sea. South Korea is in the same position. Most of Europe relies on imports for a substantial portion of its energy needs, especially since the disruption of Russian pipeline gas. China, despite having domestic resources, imports enormous quantities of energy to fuel its economy. All of this trade requires ships, not just any ships, but specialized vessels designed for safe, efficient transport of these critical commodities. The LNG trade in particular is poised for continued growth. Natural gas is the cleanest burning fossil fuel, producing less carbon dioxide and virtually no particulate matter compared to coal. As countries work to reduce emissions while maintaining reliable electricity generation, natural gas is playing an increasingly important role. And since natural gas is difficult to transport by pipeline over long distances or across oceans, LNG shipping is essential to this energy transition. New LNG export facilities are coming online in the United States, Qatar, Australia, and other countries. New import terminals are being built in Europe and Asia. Each of these facilities needs ships to connect supply with demand. The companies that own and operate LNG carriers are positioned to benefit from this structural growth in the trade. Oil shipping dynamics are different, but equally supportive of long-term demand. While many expect oil consumption to eventually peak and decline, that peak is still years or decades away, depending on which forecast you believe. In the meantime, the oil that is produced needs to move from oil fields to refineries and from refineries to consumers. The geography of oil production is shifting, with more coming from the United States and less from traditional Middle Eastern sources. This shift actually increases the average shipping distance for oil cargoes, which is positive for tanker demand. The companies I have recommended are positioned on the right side of these long-term trends. They own the modern, efficient vessels that customers want to charter. They have the relationships and reputation to win contracts with major energy companies. And they have the financial discipline to maintain their commitments to shareholders through market cycles. Now, I want to address how you should think about monitoring these investments once you own them. One of the advantages of the contract-based model is that you do not need to follow daily news about freight rates. That information is relevant for traditional shipping companies, but largely irrelevant for these contracted businesses. Instead, you should focus on a few key metrics. First, monitor the contract backlog. Both companies report the total value of their contracted revenue and the average remaining contract duration. As long as these numbers remain healthy, the business is on track. You should be concerned if you see contract duration declining significantly without being replaced by new contracts. Second, watch the dividend coverage ratio. This is the ratio of cash flow to dividend payments. A ratio of 1.2 or higher indicates comfortable coverage. If coverage drops below 1 for an extended period, that could signal dividend pressure. Both companies typically maintain coverage well above 1, but it is worth monitoring. Third, pay attention to fleet utilization. Ships should be operating, not sitting idle. The companies I have recommended typically achieve utilization rates above 95%, meaning their vessels are earning revenue almost all the time. If utilization drops significantly, that could indicate problems with contracts or operations. Fourth, review the annual report each year to understand any changes to the business. Are they ordering new ships? What are the financing terms? Are there any contract expirations coming up? Have they renewed any contracts, and at what rates? This annual review does not need to be exhaustive, but it should confirm that the business remains on track. Beyond these specific metrics, trust your common sense. If a company that has paid consistent dividends for 10 years suddenly cuts the dividend, something has changed. If management that has been disciplined about debt suddenly takes on massive new borrowings, something has changed. If counterparty quality deteriorates or contract terms become unfavorable, something has changed. Any of these would warrant a closer look and possibly a reevaluation of the investment. That is why these are the only two shipping stocks I would trust for passive income. Not because shipping is a great industry, it is not, but because these specific companies have found a way to extract reliable income from an unreliable industry. They have taken volatility and transformed it into stability through intelligent business design, and they have proven through multiple market cycles that they can deliver for shareholders. If you are looking for yield in a world where yield is hard to find, if you want diversification that goes beyond the usual suspects, if you value simplicity and clarity in your investments, these shipping stocks deserve your consideration. They may not be exciting, they may not make headlines, but they can quietly generate income for years and decades while you focus on the things that really matter in life. And in the end, is that not what investing is supposed to do?